Ms. Amiko to deliver her presentation for us today.
Ahlan wa sahlan. Good afternoon, ladies and gentlemen. It is my pleasure to be invited here today again to Kuwait to participate in this dialogue on corporate governance organized by the Kuwait Capital Market Authority. And today, throughout the day, I saw many faces which have been of people who've been actively participating in different fora focusing on corporate governance, and new faces, which indicates there's ongoing and also new interest in the issue of corporate governance in the region and here in the GCC specifically. I thought perhaps as a way of introduction I would say a few words about what the OECD has been doing in the region. Some of you already know what our work over the last few years, but I thought to give a few words of background. As some of you may know, the OECD has been working or has established a project on corporate governance in the Middle East and North Africa, which works with policymakers, central banks, securities regulators, stock exchanges, and private sector participants on improving corporate governance practices. And that work has been active since about 2006, so quite a few years now. In the scope of our work on corporate governance, we include issues related to governance of state-owned enterprises, specifically to governance of banks, and to governance of listed companies, which is, I guess, more specifically our interest and focus today. And here in Kuwait, over the last few years, we have worked with a number of partners, notably, of course, the CMA, the Kuwait Stock Exchange, the Privatization Council, and the Ministry of Commerce, which has last year actually hosted our annual roundtable on corporate governance of state-owned enterprises here in Kuwait in April. So all these institutions, I think, from different vantage points, do have an important role in promoting corporate governance here in Kuwait, and I think that that actually leads me well into the topic that we were asked to address in this panel today, that is supporting environment for good corporate governance. The development of institutional frameworks for corporate governance in this part of the world, as you know, had started about a decade ago, roughly around 2002, 2003, and the debate has intensified since. We've seen in 2002 the issuance of a corporate governance code in Oman, and Oman was a sort of a leader in starting this effort to codify and introduce written rules on corporate governance in the region, which was followed then by Egypt and many other countries in the region. Today, basically almost all countries in the region have corporate governance codes or guidelines of one sort or another, and the securities regulators and/or stock exchange to oversee their implementation. Lebanon is the last country in this part of the world to have announced the formation of a securities regulator, and I believe the only country that still doesn't have a stock exchange is Yemen, but basically everyone in the region has made serious progress in this regard. An interesting trend, I think, to highlight in terms of looking at the institutional frameworks and how corporate governance has been promoted in this part of the world is that the establishment of capital markets authorities has in many ways and in many countries followed the development of expertise in corporate governance in the banking sector. And the banks have, in many countries, notably Lebanon, here in Kuwait, and in other places, the central banks have in many ways been the first sort of entities to promote governance standards among banks, because as we all know, banks in the sense have great implications if the corporate governance practices aren't aligned, and then there are issues in the risk management or in the stability of the banking sector, and therefore that was sort of the birth of corporate governance standards in most countries in this part of the world. But as we know, that experience has now been not transferred to, but in a way leveraged by capital market regulators across the region, and many of them have now dedicated departments which are dedicated to overseeing the adoption of good corporate governance practices among listed companies, and of course the presentation of our Saudi colleague earlier today was a perfect example of that. So the debate, if I may summarize it, in the last 2-3 years in the corporate governance field in this part of the world has rightfully focused on the issue of enforcement. When we attend conferences or events, or when we are in discussions with regulators in this region, the question that we often hear is, well, we have now the rules for corporate governance, now how do we ensure they're applied? Should we make these codes that exist mandatory? Should we keep them voluntary? Should companies be required to report on their compliance on a comply and explain basis, as we have heard is the model in Europe? Should listing requirements now include some corporate governance standards? That is the case, for example, in Egypt, in New York, and in many other parts of the world. So these are the kinds of questions that we hear, and I think there are sort of two sides of the coin. On the one hand, there is a concern that if standards are made mandatory or comply or explain, there might be a fear in the listed company sector that they're being asked to disclose too much, and they would either delist or companies would not come to the market to list. On the other hand, regulators are certainly cognizant of the fact that if the requirements that they put forth are seen as weak or insufficient, then the investors will not actually find their market attractive. And so that is, I think, the trade-off that, along which we've been discussing this region, in this region now. And in fact, again, going back to the general public debate on corporate governance in the MENA region, what we often hear is this term corporate governance compliance. But what does this corporate governance compliance actually mean? And what do companies need to do to get there? And I think all these questions go back to the issue, again, of supporting environment for corporate governance, and this topic that we're working on here in this panel. And if I were to take the analogy of a famous toy, Lego, I would say that there are several building blocks to the issue of to creating an environment for sound corporate governance. Of course, we have the institutional environment, the creation of structures like securities regulators and stock exchanges, but we also have the companies themselves. And here we should ask questions like what kinds of companies are listed in these markets? What is the level of development of public markets? What is the level of dynamism in the IPO markets? Who are the shareholders? Are they long-term? And we also have, of course, the investor community, which is the third block that I will come to later in this presentation. And as I said, the regulatory and institutional environment here matters too, and the cooperation between the level of cooperation and the quality of cooperation between bodies like central banks, securities regulators, and stock exchanges is primordial in ensuring that there is sound corporate governances are put in place. Because, for example, if we look at the banking sector, banks are regulated in most jurisdictions by central banks, if they're listed by securities regulators, and to some extent if they're by the stock exchanges if they are listed. So these are all pieces of the puzzle that I would call good corporate governance. Without shareholder engagement, enforcement can only be as effective as any stick without a carrot. And on the other hand, without effective enforcement, minority shareholders might risk getting abused, and therefore investors might potentially not go to these markets. So in my presentation today, what I thought to do is to actually address these building blocks of this Lego puzzle a little bit separately. And first I thought to look at companies, because if we're talking about corporate governance, companies are an inevitable starting point. And here I think it's maybe worth to abstract a little bit and look at the trends globally. What has been happening to listed companies globally? And here it's a little bit of I would say, a mixed picture in the sense that the level of companies going to public markets now all over the world has been in a serious decline. And I think that's sort of the overarching, I guess, theme to what is happening in the corporate world as far as listed markets are concerned. So if compared to the 1990s, the initial public offerings in the US has fallen by about 75% from an annual average of about 500 to just over 100 offerings per year. And these are some serious numbers. And that, of course, is not strictly limited to the United States. In the UK, the same trend we've seen has been reproduced, and the number of listings over the last decade has gone significantly down. It could be argued that some of these changes are a little bit cyclical in nature. We've seen that the impact of the financial crisis obviously cannot be ignored, and companies have been more reluctant to come to public markets. but it's perhaps worth to look at more structural reasons and realize that these trends are not sort of limited to UK and the US. If we look at beyond these markets, globally, the average volume of IPOs in the period of 93 to 2000 was about $130 billion. And in the following years, it was about 70, so just a little bit over half. And I think these trends show that this is, in fact, a serious trend to sort of take into account and reflect. And bringing it back to the region, I think it's interesting to think about how does the MENA region fit into this picture, if at all? Does the trend affect the MENA region? You know, the decline in IPOs, to what extent is it reflected here in the Gulf? And we work with heads of stock exchanges from the Middle East and North Africa region in what we call the task force of MENA stock exchanges for corporate governance, and we hear interesting feedback from them on this point. It's clear that in the last 2 years, the exchanges have struggled to maintain their performance, both in terms of volumes and valuations. And there's been quite a lot of instability following, of course, revolutions in Egypt and Tunisia. But the good news, I think, is that the IPO performance has started to somewhat pick up, I think, in 2012. An estimated $2 billion was raised by companies from the Arab world in 2012 in about 14 deals. And this year has already seen some positive developments, such as the IPO of Asia Cell in Iraq, which is estimated to raise about over $1 billion. So from my perspective, I guess the current environment can be, from the company side, can be characterized as one of cautious optimism. Companies are going public, but I think the volumes hide to some extent the fact that there's a very few high-value IPOs. It's not that we're seeing significant IPO activity in terms of the actual number of primary or secondary deals. The other question that is perhaps a secondary question, but also an interesting one, and that we've been discussing in our work, is the fact that some of the largest companies in the region are actually issuing stock or depository receipts in markets outside the region. So an example of that could be DP World, which has issued stock in London in 2011, and many other companies which are actually going outside the region. And I think this is something that perhaps is worth reflecting on. Why is it that local companies are choosing foreign markets for their primary listings? From our work, again, with heads of stock exchanges from the region, it's clearly not for the lack of effort on the part of stock exchanges to try to both attract and retain existing listings. And there are a couple of points that I wanted to highlight in terms of the developments in the actual stock exchange industry. What are stock exchanges doing to promote themselves? First, it bears to say that the stock exchanges are clearly and actively considering the form, the legal form and the operational form that would enable them to be more competitive. And the direction of that reflection has been, at least in many markets, privatization or demutualization of exchanges. And we're not necessarily, as OECD, advocating privatization or demutualization. We're just noting the fact that in the region, there's a serious interest in that, not only here in Kuwait, but also in Morocco, in Egypt, and Istanbul, where discussions have been ongoing as to what would be the optimal operational or organizational form for exchanges to attract greater investment and to be more competitive globally. There are other themes that we picked up on in our work, notably the creation of secondary listing tiers or differentiated segments, which would basically be created to attract companies, family-owned SME companies or growth companies to come to public markets. And this is driven by the recognition that this single listing standard might not be sufficiently flexible to accommodate the financial and corporate structures of companies across the spectrum. We also note in our recent work through a survey that we're currently conducting with stock exchanges as to the structure and quality of their listing standards, that many exchanges in this part of the world have been revising their listing rules in the last few years in order to bring them in line with international standards. And of course, we all know that a number of exchanges have been trying to to basically create rules such that and structures such that they would enter global indices such as MSCI, with the hope that that would help them to attract institutional capital or foreign capital from abroad. I think currently only Egypt and Morocco are members are part of the MSCI, and I think there's a greater interest in the MENA region to kind of for the exchanges to become part of these global indices, and it's debatable to what extent that might bring more capital in the region. I think it's also important, and clearly in our discussions here today, it's undisputable that capital market regulators play a fundamental role, if not the biggest role, in terms of regulating and enforcing corporate governance rules. And in most countries in this region, including Kuwait, UAE, Saudi Arabia, capital market regulators are in fact the engines of corporate governance rules and enforcement. And enforcement, as I mentioned, is a key topic for discussion lately, because rules are already in place, but there's perhaps a lack of clarity as to how we can really ensure that companies take them seriously. And we're seeing, as was mentioned also in the presentation of a colleague from Saudi Arabia, that there are quite a number of enforcement cases, and some of them are perhaps worth mentioning. Just to take one example, in the UAE, there's been, as you probably know, a high-profile investigation by the securities regulator, the Emirate Securities and Commodities Authority, of the Damas case, where the two controlling shareholders, the Abdullah brothers, were accused of embezzling funds from the company. And through a lengthy investigation process, ESCA had actually ordered them to repay the funds, and also has issued a penalty of $700,000 on the two controlling shareholders as a sign that they're perhaps not willing to tolerate this kind of instances anymore. Now, in these cases, I think demonstrates that at least some regulators and stock exchanges in the regions are what we call growing teeth. And again, the Saudi CMA if you look at, for example, the report of the annual report of the Saudi CMA, it's very interesting to look at the details of the enforcement cases. And I think in 2011, there was about 300 of them, and a lot of them are fundamentally, in some ways, touching issues of corporate governance. They're maybe not all, related 100% to how companies may be or may be not in compliance with standards, but in some ways or another, a lot of them do touch on issues that we've been discussing, on independence of board members, on quality of disclosure, and many others. And I think in that context, it's interesting to say that this emerging, the next thing I think to look out for would be the discovery powers of regulators. And when I say discovery powers, I mean the ability of regulators to actually go to companies and request certain documents, and the ability of regulators to support the idea that shareholders can file complaints with them, and that they can effectively investigate these complaints with companies. So the power of securities regulators in this regard is also important. And here I come to sort of the third building block of the presentation, and that is the investor community. And the question here is this regulatory compliance approach to corporate governance enough? What we currently see is that companies are basically told, we are revising standard X or standard Y, you must have a third of the board as independent directors. And so, frankly, as a listed company, they don't have much of a choice unless they don't want to remain listed. So, in a sense, the incentives for corporates to apply corporate governance rules comes almost, I don't want to say 100%, but in a very significant way, the incentive for compliance comes really from regulatory standards being imposed on them. And the question is really, is that enough? And what can we realistically expect of companies if the only if the only way to enforce is by sort of this stick approach? And and the related question is, who would be the demandeur, as we say in French, or who would be the people who would be interested in corporate governance, who would be perhaps not on the stick side, but on the carrot side? And I think that's clearly the investors. And they are the last piece of the puzzle that I wanted to address today. Obviously, the key question here is, who are the investors in the listed companies in the Middle East and North Africa region? We know that these markets are driven primarily by sort of household investment, but also we see a number of large investors, be it family offices or sovereign wealth funds, which particularly here in the Gulf do have huge stakes in capital markets, as we know, and do have the potential to influence corporate governance practices in the long term. And the level and sort of the structure of investment here in the Gulf and the MENA region more broadly is quite different than what we see in Europe or North America, where it's basically pension funds, mutual funds, and insurance companies that control the market capitalization. If you look globally, these funds control about half of the market capitalization at about $26 trillion. And here, of course, the picture is slightly different. And I think when we think about the potential role of investors in promoting corporate governance, we need to think about who are these investors and what are the motivations on their side. I think clearly on the side of large institutional investors like the sovereign wealth funds and others, the motivations are there. But if you look at the retail investors, of course, there's only so much we could say they could do in trying to promote corporate governance. But at the same time, we see that the levels of pension and insurance funds are developing in the region. And so indirectly, in the long term, they will have a greater role to play in capital markets. Currently, MENA households are estimated to hold about $2.7 trillion of assets, and 65% of that is held in cash and deposits, whereas only 14% is invested in bonds and 18% in equity markets. So these are quite relatively low numbers compared to Europe or North America, and show that there's a possibility for further development of level in terms of the level of investment of private households in capital markets, and consequently the ability to, in the long term, influence corporate governance practices in the market, assuming that they are investing through pension funds or insurance funds or through other vehicles. So in conclusion, I just wanted to highlight that from our perspective, the potential role of large private and institutional investors is significant in the long term, and perhaps the voice of investors, of these large investors, needs to be amplified somehow. That on the side of companies, that they realize that demand for corporate governance comes not only from the regulators but from the investors. And I think it's only when there's a balance between this sort of carrot and stick approach that the environment or the framework for corporate governance will actually be quite effective. So the last point that I wanted to, and to this end actually, what we're doing is launching at the OECD an initiative called MENA Investor Council, which will aim to regroup these large investors, bring them together to the table so that they can have, let's not say a single voice, but a louder voice in trying to say what they're looking for in terms of governance practices, in the hope that that will entice corporates to listen better, let's say. So I would like to probably stop here, and I'd be more than happy to take any questions you may have. شكرا جزيلا.
Thank you, Alisa, for the interesting presentation, where I tried to summarize what you have probably touched upon. First of all, you gave us the OECD perspective on the MENA region level of corporate governance advancement and what's needed to be probably introduced within the MENA region to promote more good corporate governance. And you've touched upon that basically on the building block approach on the three levels. The first level is the rules and directives and regulations that ought to be addressed by market regulators. The second building block is the role of market or exchanges, stock exchanges. And that all depends on the level of advancement on those stock exchanges. And the third and the most important is the investor perspectives. And probably the initiative that you've highlighted at the end of your speech does cater and complement what has been mentioned today about the rights of the creditors as well as investors, stakeholders, when it comes to the tailoring of the corporate governance rules. One interesting point that you've mentioned is the level of advancement in the corporate governance, which is, as you rightly have highlighted, it's positively correlated with the level of raising required capital within the market in the form of IPOs. You made a comparison between MENA region countries as well as Europe and the US. In that prospect, do you see any country bias when it comes to the level of advancement in the countries, i.e. MENA region countries as well as US and Europe, and the level of, let's say, sophistication in the corporate governance codes and the application of corporate governance? That is to say, does this kind of comparison probably needs more investigation on the reasoning behind the modest level of IPO within the region vis-a-vis the European level of IPOs and the US? Sure.
I just want to explain that the intention behind the numbers that I cited wasn't necessarily to draw a comparison between what is happening in Europe and North America, but more to situate the MENA region in a set of global trends, things that we're seeing happening all over the place. So in a way, I would give an example. A journalist called last week from Morocco and he said, could you explain to me why there are no IPOs in Morocco? There was one IPO in Morocco last year. And I tried to explain to him or tell him a similar story in the sense that, of course, this is happening in the region, but this is happening not only in the region, this is happening elsewhere. And companies are looking at alternative means of financing, and the idea that all companies have a broad dispersed shareholder base isn't necessarily the case everywhere. And it used to be a little bit of a dominant discourse in when people talk about corporate governance, they talk about dispersed shareholders and IPOs. But the reality in this region, as we all know, is that IPOs are not the dominant way of raising capital. In fact, and bank-based finance was always the case, so was more predominant. So the point was not to make the comparison, but to situate the MENA region in that context and to say that this is happening globally. There are few markets except for, I think, Saudi that had 7 or 8 IPOs last year, but also it's relative to the market size, so obviously it would be difficult to compare Saudi Arabia to, let's say, Syria with 4 listed companies. So we are seeing these trends, and I think that there are a couple of questions to continue investigating, and not so much in the comparative context, Europe vis-a-vis the MENA region, but more in the MENA region to sort of to look at questions like the one I posed. Why are companies going abroad whereas they can stay in this region and raise funds through local markets? Or why are companies not able to dual list? I know of examples where there are entrepreneurs who are willing to go public, for example, in Tunisia and Algeria, and they're not able to organize that because of regulatory barriers. So I think that these are perhaps more relevant, from my personal perspective, perhaps more relevant questions to ask and to say, well, is what is happening here in Kuwait comparable to what is happening in the US? Because it's such a different environment.
Absolutely right. Probably the second question, and probably Amelda will pick up that in her presentation. Do you think, from your prospect as an OECD, based on your research and involvement within the region, that the concentration in capital does play a role in having a modest level of IPOs within the region?
Yeah. No, concentration of ownership, I think, it's something we cannot avoid talking about, because that's the departing sort of point of corporate structures here. There are very few companies where which have dispersed sort of ownership. Most companies, it's difficult to say, because even if shareholders don't have, let's say, 50% control block, if the founding shareholder doesn't have a 50% block, if they have only 20 or 30, but the rest of the shareholders are not major shareholders, they still have a control in a company. So in reality, in this part of the world, again, it's no secret to say that these structures are prevalent, and to some extent that might be pose some concerns to large investors or institutional investors who might be entering the market and saying, well, we're not sure what we can do with these companies because they are controlled companies. But on the other hand, these controlled structures are prevalent all over the place, virtually with the only exception of UK in US, basically, if you look at Sweden, if you look at even Canada, I mean, Canada is not a model of dispersed ownership, and that's a model that was discussed earlier today. And perhaps these kind of models, like Sweden, like Canada, like Italy, are, in my view, more relevant to the region because they have these sort of similar ownership models. And it's interesting to look at how different jurisdictions have actually dealt with controlling ownership to make the corporate governance rules effective. And one example that was cited earlier today was in Italy, they have a minority shareholder representative in the board. And there are other mechanisms that we don't have time to go into today, but I think the question is how to adapt the rules to make the structure be effectively to make the structure be unproblematic from a corporate governance perspective.
Brief comment, and then we can move to...
Just very quickly. This issue of the value of having concentrated ownership versus dispersed ownership is quite a hot issue. I was at a roundtable in London about 3 weeks ago where this was the subject, and people were saying, well, actually one of the problems we have in the United Kingdom is we don't have enough concentration. What we have in the United Kingdom is very dispersed shareholdings and people who don't take responsibility for their ownership. And actually, in that context, what you want is greater concentration, so you've got shareholders who have some responsibility and take some responsibility for the companies that they own.
Great. With that, I believe